Vaccine makers like Moderna, BioNTech, and Pfizer are surging today. In the next 5 minutes, I'm going to tell you why and tell you if I own or plan to own these stocks. This is Austin Lieberman, and you can find deeper level research and deep dives in my email newsletter, austin.substack.com. Make sure you like and subscribe to this video so you never miss an update on the markets. Let's get into these stocks. So we've got Moderna, ticker is MRNA, which last I looked was up 13% today. BioNTech up 16% today. Novavax up 9% today. Pfizer up 5%. And Vertex Pharmaceuticals up 2%. So let's jump into why. So first, let's look at the market overall. We've got the, looks like the Dow is up a little bit. S&P 500 is flat to down, and NASDAQ is down 1%, right? And so specifically, we've got the top movers, which are these vaccine producers, or at least Moderna to start, up 13%, and other stuff's basically down, right? So why? Well, there's news out of China. Moderna, BioNTech on the rise amid concerns over a new variant in China and an outbreak. And so basically, this is a Seeking Alpha article just talking about vaccine makers are surging amid concerns over a new COVID-19 variant. So that's the news. There's China's National Health Commission reported 3,122 cases, which is the highest number since the initial outbreak in January of 2020. So big numbers, at least according to the news for China. And then look, another article that's just talking about how fully vaccinated will need a fourth dose later this year. A new variant dubbed Deltacron detected in Europe. So the kind of the most important thing, at least when I think about this stuff, is what does that actually mean for the stocks that are moving today? Is it a justified move? And, is this a company that I want to become an owner of? Because when we own stocks, we're not just throwing ticker symbols around, even though that's kind of what's been popular out there. When you own shares of a stock, it's unpopular to say, but it's the truth. You are a very small part owner of the business. So when I think about these, I think about if I want to be an owner of the business. So let's get to the businesses behind these companies. So BioNTech, it looks like, based on history, that this has only been traded since really 2020. And we're looking at a graph showing their operated earnings compared to the price. Well, they have never had operating earnings before, but they had, they're estimated to have 39.70 of earnings per share in 2021. And then that is actually expected to drop in 2022 and 2023. And so when we look at the price today and we look at the forecasted growth rate by analysts, according to Fast Graphs, it looks like earnings are going to be shrinking over the next 2 years. And so if we take this line from a PE, price to earnings ratio, of 3.4 right now, and we go out to even 7 or so, which would be a double on the multiple from here with shrinking earnings, you're looking at an annualized rate of return of 10%. And so it's hard to tell if looking at these long-term projections, no one has any idea. That's why I paused. No one has any idea what those look like over the long term. And so with this company, if you're owning BNTX right now, you're basically just owning it because you think it's going to go up in the short term and that sales or earnings are going to skyrocket way higher than what's already expected based on everything that's happened with COVID so far. Do I believe that? Am I buying this in my portfolio? No, but I'm just a random guy on YouTube, not a financial advisor, so you do what you want. Johnson & Johnson, didn't mention this up front, but if we look at Johnson & Johnson, their historical averages, right? So Johnson & Johnson has traded at a average PE ratio of 17 with about 8% average earnings growth since 2002. So you can see that this black line has stayed around these blue and orange lines pretty much for its entire existence, except for these past 2 years, really since COVID, it's actually traded a little bit above its historical multiple, probably because of expectations around COVID. And so, it would lead us to believe that it could stay in that range. And so if it does, then you're looking at through December 31st, 2024, you get a 22% annualized return, and you get a 22% total return with a 7.5% annualized return. Johnson & Johnson is a very real company with a long history of performance and raising their dividend. It's actually trailed the S&P 500 since 2001, but just briefly. But for people that are looking for some solid dividend income, Johnson & Johnson could be a great option. I don't own it. And again, we see that their blended price to earnings ratio is 17 right now. But over the next 3 years, basically, they're expected to grow earnings at about 5% annually. And so if we take that line to the a 15 price to earnings ratio out to 2024, you're only looking at a 2% annualized return. And so that makes it a little bit less interesting than if it were to stay up at the 17. And so that's down to this one. All right, so Johnson & Johnson, I don't own it, and I'm probably not going to own it, although I would consider it for the dividend portion of my portfolio. Moderna, the big one. This is the big one that everybody's talking about. And the big one that's up a lot today, right? And so, again, not a lot of history, which makes me hesitant to own a company to begin with. What do we know about management? What's their track record? And the truth is, there's not a long history of at least public market execution and success here. And so if we look, they grew from essentially negative earnings to insane earnings growth in 2021, all on the back of this vaccine, right? Well, over the next 3 years, analysts are expecting earnings to shrink, which obviously could change if maybe there's a lot more than what's already expected needed for COVID. But it's trading at a blended price to earnings ratio of about 5 right now, with even a normal of 8.98. So if we go out to 2024 and it's trading at a price to earnings multiple of 15 at that time, you're looking at a negative return from today based on analyst current expectations. Again, those expectations could change. If it goes down to the 8.98 normal price to earnings ratio, which is above its current price to earnings ratio, you're looking at a negative 22% annualized return or negative 51% total return. Again, not a lot of history of success prior to 2018 because, according to this, it was not a public company prior to 2018, and I'm not going to say it wasn't because I haven't looked to check its IPO date or the date it came public, but I trust this data, and so not a long track record of success. I will not be buying Moderna because I don't like short-term plays on a certain trend or industry. I want to own a company for a very long time. Novavax, so the problem with Novavax, NVAX, is that it basically since 2003, even if you go to today's price, which is way up from what it was 2019, you're looking at a negative return since 2003. It's had some ups and downs, but every time this company has traded higher, it looked like it was on probably some fear of a pandemic or something in other countries or somewhere around the world. And then that excitement wore out, which is exactly what happened with COVID. And so the question is this something that we want to own going forward? It doesn't even show a normalized PE ratio because they were not a profitable company in pretty much its entire existence prior to 2021, 2022. Really, so for that reason alone, I'm not going to be owning NVAX. And Pfizer's another one. This is actually, a company with a track record of being a public company. And so historically, over the last 20 or so years, it's had a normal PE ratio of 12.6 with about 5% earnings growth. And actually, if you look at it so it's trades at about a PE of 10 right now. And if it gets back to a PE of 12, which is its average, you do have a 4.4% annualized return from now until 2024. Is that great? No. But it's not like this is going to go to zero or anything like that, at least most likely not. And then if it does get up to a PE of 15, which is probably unlikely unless something crazy happens, then you're looking at a 32% return or a 10% annualized return. The thing about Pfizer is since 2001, it has actually lost to the S&P 500, but it was definitely overvalued then if you see this black line above the orange and blue lines. And so right now it's showing undervalued compared to analyst expectations of earnings growth. And so if you take it from a time in about 2004 where it was undervalued and you go to today, it returned 6% annually. So that's a little better, but still, probably losing to the S&P 500 over that time. And so again, with the other options that I have, I'm not going to be buying Pfizer, especially just not on this exciting news for the company. That's, I hate to say exciting because, people are suffering from, some type of disease or sickness. But it's not the type of company I want to own when there's other companies that I can own out there and that I do own. So again, commonstock.com, it's the most transparent investing community on the web, in my opinion. Disclosure, I'm an employee at commonstock.com because I like the product so much. But here's my portfolio. It's linked. You can always check it out. And you can see the stocks that I do own, and they're all pretty much down today, it looks like. So it looks like the market's down. Not super concerned, but a lot of tech, a lot of cloud, and then I do own some dividend payers. Two in kind of the medical industry that I do own are Amgen and AbbVie. And so none of this is advice, just a man with a chicken on YouTube. And would love for you to like and subscribe to this video, and then check out my newsletter, austin.substack.com, and let me know what you think of these videos if you have any requests for companies that I could cover. Thanks.